What's up, everybody, and Happy New Year! It is New Year's Eve. I got, about 7.5, 8 hours left to go before the ball drops here in Times Square. For those of you who have already celebrated, I got subscribers out there in Australia. Congratulations and welcome into 2022. So the year 2021 is over. It's been a good year, folks, a fantastic market. I think, my forecasts were right on, talking about strong fiscal flows. Now, the thing is, we're coming into a year that might see some moderation. It's going to get a little bit trickier in 2022 because we probably will see some moderation, some slowing. I've been talking about this in the fiscal flows. That's going to be critical. But at the same time, we are seeing, or I am seeing, bank credit expanding at a pretty rapid pace. I mean, we're kind of back to the loan growth pace of pre-pandemic levels. So, that could in itself be supportive or at least offset the pullback in the fiscal flows. The only thing is, with bank credit, what happens? I mean, people go further into debt, right? When the government sends you a check, that's your money to keep. It doesn't come with any offsetting liability. You get a Social Security check, or you get an unemployment check, or you get a disability check, or whatever. That's money for you to keep. That raises your financial balance, all else equal. When you get a loan from a bank, that's great. You get money in your checking account, but at the same time, you have a debt that comes with interest that you have to pay off. So there's no net increase in your net worth. So the good news is that right now, if you look at debt burdens as a percentage of disposable income, it's still at very, very low levels. Like, we are nowhere near the debt burden levels that we saw in 2007 before the great financial crash. That was one of the problems, that the government was shrinking its fiscal support. At that time, the deficit got all the way down to something like 1.5% of GDP, okay? And debt burdens were really, really high. So the fiscal support was not sufficient to support the credit structure of the economy, and that's why it was like a tinderbox that was ready to go up. And even so, it could have been mitigated with the right response, but I don't want to get into a whole discussion of that right now. What I'm saying is, I really have to see the numbers in early 2022. I mean, maybe the fiscal situation will not be that bad. I mean, if we're hanging around 500 billion in monthly flows, that's still a significant increase from the pre-pandemic levels. I know yesterday I said right now it looks like we're running something around 360 billion. The other thing is that expect to see the deficit shrink very rapidly. Right now, it's already down 100 billion versus where it was at this time last year, and that's going to shrink very quick because tax flows, I've spoken about this before, tax flows, when you get to a certain point of economic expansion, it's like a reverse automatic stabilizer. It's like an automatic destabilizer. Tax flows start to exceed the spending. Yesterday I gave you the swimming pool analogy again, and I said the leak is getting larger. The water's flowing into the pool at a slower rate, and the drainage from those tax collections is draining out the pool at a faster rate, so the level is coming down. What is that? What does that level represent? That level represents the stock of financial savings of the non-government, right? It's our savings. And that is going down, and you could see this in the charts. If you go to any chart now of personal saving, and the best database, of course, is the St. Louis Fed. If you go to the FRED, F-R-E-D, at the St. Louis Fed, and just type in there personal saving, you'll see it spiked way, way up in the first phase of the stimulus last year, or in last year in 2020, went all the way up to 6 trillion, unprecedented, historically high saving. That's when all these clowns were saying, well, it's because, we didn't go to the movies and we didn't go to restaurants. And I'm like, idiot, if I don't go to the movies and I don't go to restaurants, then the movie theater owner and the restaurant owner sees their income and savings go down. So, I mean, that's not the way we save in the aggregate. Okay, that's called fallacy of composition. But it spiked way up, and now it's way back down. I shouldn't say it's way back down because it's like 1.2 trillion. That's still historically a very high level compared to, like, in past years, it used to run anywhere from like 300 billion to 600 billion. We're still easily 2, 3, 4 times that, but it has come way down from that 6 trillion. And it's going to drop a lot faster now that that deficit is shrinking. You'll see. I'll bring it up to you like, every now and then, and you're going to see it. I'll make a video with some charts so you can see it too. So yeah, we got to see the numbers next year. So we got a bunch of new dynamics here. We got slowing fiscal. I think, okay, that's still up for question because again, we're gonna get Social Security payment increase, stuff like that. We got slow, and who knows? Maybe that Build Back Better thing will happen. We don't know yet. The Congress is, the Senate is gonna retry that again in early January. But let's assume we got slowing fiscal, all right? We got bank credit expanding, so that's an offset. But at the same time, we'll see household debt levels rise. That's what happens. When the government shrinks its debt, the non-government's debt goes up. When the government expands its debt, it's not really debt, okay? The non-government's debt goes down. We saw this very clearly, and the non-government's stock of savings go up. They're inverse and they're equal to the penny. So, and then we're going to have rate hikes by the Fed, and I do think the Fed is going to go ahead with that because I believe, the Fed thinks that it's their credibility at stake, and that's why they're going to do these rate hikes no matter what. And let me tell you something, these rate hikes are not going to squash inflation. Rate hikes are price hikes. The cost of credit is reflected in the cost of all goods and services. So it will not bring down inflation. The only thing we have to hope for, and I think we'll see this happen, is that the supply chain issues will mostly get resolved, and we'll see, shelves will be stocked with goods, and prices will stabilize, but they probably would have come down were it not for the Fed's rate hikes, and they might come down a little bit too. So the restocking, the resupply of inventory will at least offset some of what the damage that the Fed is going to do with interest rate hikes. Anyway, it's going to be a puzzle, like always. When is it not, right? And we're going to have to figure it out, which we will, and we'll be on the right side of these macro trends. And again, some of you have been hitting me up saying, hey, look, Mike, I'm interested in a single, individual subscription. Can you help me out? Send me an email. Let's talk, okay? mnorman@pitbulleconomics.com. Everybody have a fantastic, safe, healthy New Year's Eve, and I'll see you maybe over the weekend. Bye-bye. Happy New Year.